Why has Tesla had such a difficult time? Why are earnings down almost 60% since 2022? And the stock is flat.
Sure. The data we have is incredibly detailed.
Today, we are going to focus mostly on one of the stocks that you cover, Tesla.
Probably the number one issue facing Tesla in the last few years is that they enjoyed tremendous success off a single vehicle platform, the Model 3 and the Model Y, and they let the vehicles at some point get a little bit older. You could almost say Tesla's kind of violated an age-old rule in automotive. You do have to refresh your vehicle. Software is great. Over-the-air updates are great, but it's not enough.
You need excitement. What exactly did the Trump administration do in the tax bill, and how much does that raise the price of electronic vehicle cars? So Elon got involved with politics. How much do you think what he did in politics has hurt his brand in the United States?
Yeah!
What can happen in a world of autonomous vehicles?
Robotaxi gets like 90% of the attention, but there's so much more that can happen in what we call a consumer AV.
Let's just talk about China. I got a lot of questions about this. Are the cars that the Chinese are making in China, in your view, better than Tesla cars?
What we've seen the last few years from local Chinese automakers is impressive technology and very impressive speed to development.
There's no evidence that China, at least at this point, is ahead in AV. Is there or is there not?
There's no question that there is a race.
Did Tesla teach China how to make electronic vehicles, and now that's coming back to haunt them? Hi, this is Steve Eisman, and welcome to another episode of the Real Eisman Playbook. And today, my guest is Itay Michaeli, who is the Senior Auto Analyst at TD Cowen. Welcome, Itay.
Thanks for having me, Steve.
And today, we are going to focus mostly on one of the stocks that you cover, Tesla. And if we have time, we'll broaden the conversation out. So let me start with this. So Tesla has a market cap of $1.1 trillion. The stock, I think this might be shocking to a lot of people given that it's always in the press, has basically been flat since 2022. And let me just read you some numbers. So in 2022, Tesla earned over $4. And ever since then, the earnings have gone basically straight down. So that from 2022, which was the peak, if the estimates are correct, the consensus estimate is today, the earnings are going to be down 57% versus the peak in 2022, and the stock is flat. So let's leave aside the stock, and let's just talk about why are earnings down almost 60% since 2022?
Absolutely. First, again, thank you for having me, Steve. It's great to be here. So there are a lot of reasons why earnings have fallen about 50%, you're right, this year versus the peak. I think probably the number one issue facing Tesla in the last few years is that they enjoyed tremendous success off a single platform, a vehicle platform, the Model 3 and the Model Y. And they let the vehicles at some point get a little bit older. And so the one thing that hasn't changed in the EV era is that a vehicle is still very much an emotional purchase. And so just because you have very competitive costs and even a compelling product with a lot of software updates, what we've learned is it doesn't necessarily absolve you from doing more classic redesigns, refreshes, and growing your product lineup. And as a result of that, I think some of the sales have come down. At the same time, you had more competition, particularly over in China, to some degree in the US. And the last is just really the overall slowdown you've seen in the EV market, as well as some macro pressures from that. So in other words, we came from a period at that $4 per share and maybe 25% gross margin you mentioned at the peak, where they're probably over-earning for where they were at the given time in their product cycle.
Let's sort of break that down one at a time. So let's just talk about China. Did Tesla teach China how to make electronic vehicles, and now that's coming back to haunt them?
It's fair to say that, yeah, they were the leaders there. And what we've seen the last few years from local Chinese automakers is impressive technology and very impressive speed to development. We talk to auto suppliers, they'll say that, they'll book business with a Chinese automaker that will launch in 9 months. Here in Europe, that could be 2 years. And so absolutely.
But Tesla makes cars in China, doesn't it?
Yes.
So let me rephrase the question. Are the cars that the Chinese are making in China, in your view, better than Tesla cars?
It's really subjective. They certainly today have great technology. They're very competitive on costs.
Are they cheaper?
Oh yeah, there's a lot of different price points, and so Tesla is not really going for like the low end where some of the local Chinese players are. When you look at Tesla's market share within its price band in China, it's come down a little bit. There's been more competition, but it's still fairly strong. So if you look at it from like where Tesla is sort of trying to compete, they're still doing fairly well despite more competition. But overall, yeah, what you've seen from the Chinese players in terms of product, tech, innovation, speed, is very different from what you've seen in the US and Europe thus far.
So, one thing that, I'm no expert here, but one thing that I read about a lot is that Tesla has promised a lower price point for a long time. The Chinese, as you just said, have managed to create cars now at pretty much all the price points. Tesla's kind of stuck at where it's stuck. Why has Tesla had such a difficult time producing a car at a lower price point, which they promised for quite a long time?
Yeah, absolutely. To some degree, it's because the price points of the current platform, the 3 and the Y, have actually come down. If you look at, like in the US, for example, excluding any credits, what you can buy a Model 3 and a Model Y for, they're very affordable relative to the average price of a new vehicle.
What does it cost today if I were to go out and buy one?
Low 40s to high 40s typically is the range, depending on the configuration. The average price of a new vehicle in the US is in the mid 40s. And of course, these are high performing.
That's without a credit.
Without a credit, yeah, you're well into the 40s, and so the platform itself today has become more affordable.
But do the Chinese? I'm sorry to interrupt. Are the Chinese producing cars even at a lower price point?
Yes. Now, it might be different specs, but they are producing vehicles at a lower price point
in
China. The BYD vehicles, where's the Seagull? The Xiaomi has new vehicles or actually are more competing directly with Tesla. So part of the comparison of what you're producing for cost depends on the features, the segment, and what you're trying to go after. But broadly for Tesla, the current vehicles today don't have as much of an affordability problem as commonly perceived. The bigger issue is, frankly, they're the same or similar designs that they've been in a long time.
Nice.
And you kind of need to broaden it out. If you look at every successful large car company, you eventually have multiple brands, multiple design languages, still within the framework of being efficient and trying to reuse parts and tooling and things like that. Cybertruck is arguably Tesla's first new brand to some extent, and so they're moving in that direction. The other, I think, to go back to your question of why they have sort of attacked that lower price point is because of the pivot. I'm sure we'll talk about this, to autonomy over the last few years, which we agree with, where the features that you can launch and the business models in some ways can, not entirely, but at some level, maybe should be more prioritized than just kind of getting to that lower price point, particularly with your current platform already getting to pretty affordable price points. So I think some of the share loss or the volume pressure really comes down to, you could almost say Tesla's kind of violated an age-old rule in automotive that years ago many thought would change in the EV era. And that rule is you do have to refresh your vehicle. Software is great. Over-the-air updates are great, but it's not enough. You still need to do more redesigns, particularly if you're looking to broaden demand geographically, right? One of the issues Tesla has is their sales are very concentrated along, in certain areas like the coasts in California. So to be able to expand to the middle of the country where EV adoption is much, much lower, maybe mid-single digit or even lower in some areas, you do need different design languages,
you need excitement.
More excitement. And so now it's a solvable issue. And frankly, the traditional car companies have done a great job at it. Think of a Yukon, for GMC versus a Chevy, a Tahoe, right? Same platform, but enough design language shift where one person may say, I like the Yukon, another person may say, I like the Tahoe. That's a beautiful thing for expanding demand. So the issues are solvable, but yeah, the core of the issue to some extent, and of course we talked about competition and that's also an issue, but the core of the issue in some respects is just these age-old rules in automotive purchasing that hold true for EVs, much like they held true for ICE for a long time.
So given what you just said, when you speak to Tesla, do they recognize this and realize that they have to really refresh the product, or are they being stubborn?
They do recognize it. We did see them refresh the Model 3 last year. They just launched a refreshed Model Y that's still ramping. They have promised their kind of new line of more affordable vehicles. It seems like those vehicles will likely be new configurations off the same platforms, maybe a more affordable Model Y version, maybe a three-row, like a larger three-row Model Y version as well. So they do recognize that they do need to do more on the product side, but because they are so focused still on autonomy, right now it's more about what can we get from the existing platform. Because the other perhaps mistake that they made throughout the years, and this is also ironically in like the history books of automotive, is taking your success, overly extrapolating where it's going to be, and then adding capacity a little bit sooner than maybe you should have otherwise. And so I think Tesla today has enough capacity for something like 3 million vehicles. I think we're estimating about 1.6 million this year. So clearly, as they're thinking about, how do we drive, solve the product issue and look to fill our capacity, the most efficient way to do it would be to leverage your existing platform, which is what they're going to do. And so I think we'll see these products probably in the third and fourth quarter of this year and ramping into 2026. And then from there, we'll kind of see, depending how the autonomy path goes, what they'll end up kind of doing for the next generation vehicle.
All right, so before we get to the change in government policy, let's just talk about Elon for a second. So Elon got involved with politics. You could argue it's good. You can argue it's bad. That's not our role here. My question for you is, how much do you think what he did in politics has hurt his brand in the United States?
Sure. So we look a lot at data to get this, because you're right. I think you have to kind of take, just look at the factual data and what it says. And the data we have is incredibly detailed. We actually look at TD Cowen county level sales data for EVs and really for everything else, but it's a little bit lagged. But let me kind of go through what we saw in Q1. So in Q1, we did see
Q1 of this year.
Of this year, of 25. Yeah, we did see. So kind of when the politics were really starting to kind of really ramping up. So we did see some loss of share in the blue, the kind of Democratic counties. But what's interesting, Steve, is we saw EV penetration decline in those counties as well. Why is that interesting? Because ultimately, as an analyst, what I care about is, are we seeing, kind of to your question, demand destruction, or are we seeing demand deferral? If it's deferral, we can kind of live with it. If it's destruction, it's obviously a bigger deal. And so the theory is that if you saw EV penetration decline in Q1 in the blue counties, then that is more indicative perhaps of demand deferral. Maybe I didn't go buy the competing EV, otherwise penetration would have been stronger. Maybe I kind of sat home and waited the storm out to see when I can go out and buy the vehicle I want to buy. And interestingly, in the red counties, we saw a little bit, maybe it was like 10 basis points, but a little bit of an uptick in EV penetration, but tiny. Although there are some counties, that are showing even stronger adoption in the red. It's an interesting question because one of the big debates during the last year's elections was, hey, if the policies are not going to be helpful to EV, how do we kind of get red county adoption to grow, right? Because red county adoption is like 5%, and blue is about 11% in the U.S.
When you say adoption, define that exactly.
Just more EVs being sold as a proportion of new vehicles. So more people kind of going out to buy EVs.
So what you're saying is in blue states, 11% of sales are EV, and in red states, it's only 5%.
Exactly. So a huge disparity, and that goes back to what we talked about before with Tesla. Like, how do you, and any EV maker or car company, how do you design vehicles that can appeal to a broader audience, not politically, but just geographically? And so it was interesting because when we saw what the political shifts Elon was taking, we were thinking, well, if you actually in theory can hold blue market share and begin to perhaps catalyze some growth in the red counties, the net of it could still be positive. And so it's a great question because it really comes down to this sort of data analysis of what's happening in blue and red. And in Q1, certainly losing share and seeing less adoption in blue is not a good thing. But we didn't see the competing EVs necessarily pick up that share, which could be a signal of deferral from here. So it's something we have to kind of keep an eye on more closely. But ultimately, as I look at it, I think it still comes down to the core of product autonomy, features, even more than some of the other noise out there.
Okay, so we're going to get to the autonomous vehicle. We're going to come to that. Let's talk about what exactly did the Trump administration do in the tax bill, and how much does that raise the price of electronic vehicle cars?
Sure. So at the end of the third quarter this year, so about a month and a half from now, the consumer purchase credit for electric vehicles, so $7,500, will expire.
Let's review. So in other words, what you're saying is right now, if I go to purchase a Tesla car, and let's say the list price is, I'll just make up a number, is $50,000, I pay $50,000 minus $7,500. Is that right, or is that not right?
It's correct if you qualify. So to purchase a vehicle, you have to have be under certain income limits, and you have to sort of qualify for the credit. Now, if you lease the vehicle, you can get it. So
you cannot get it.
You actually can. Yes. So it's sort of it's a bit of a loophole. People talk about the leasing loophole. So if you go on like the Tesla's website, you'll see the lease price is a lot lower because that includes the credit. Whereas if you purchase the vehicle, you can get it too, but you have to qualify for it. And
but if I lease it, I get it regardless.
Yes.
I see.
It should be
both are going away at the end of the third quarter.
Exactly.
Okay. So that's $7,500 basically more that people are going to be paying for EV cars after the third quarter.
Yeah, for those who are leasing, that's certainly going to be now a higher price point. And
what
for those
percentage of cars are leased?
So typically it's about 25%.
Okay.
But in EVs, clearly with the IRA credit, it's been much higher. Some vehicles, not Teslas, but some vehicles could be as high as 70 to 80%.
And Teslas are where?
It could be 50, 60. We don't have great quarterly data. It's still higher than the 25. From what we can tell, again, the data is not, it's a bit sporadic, but leasing is high. And it actually raises a good point that the industry is now kind of admitting, which is, look, this credit didn't necessarily drive massive uptake in EV adoption or new vehicle sales that are electric vehicles. But it did drive up leasing rates, which isn't the healthiest thing to do because those vehicles will come back into the market and creates maybe an unnatural flow of supply into the used market. So while the credit going away at the end of the quarter, yeah, effectively, if you qualified for the credit, will effectively mean you have to pay more than you would have otherwise by a substantial amount of $7,500. There's an argument to be made that after the hangover is beyond us, whatever Q4 or Q1 brings next year, that some of these changes could yield a healthier EV market that longer term.
So let's press the short-term point for a second. Where were sales in the second quarter? And since things are going to go away after the third quarter, where do you think sales will kind of go in the fourth and first quarter of next year?
Yeah. So EV penetration, so the percentage of new vehicle sales, has been about 7.5%. I think July, and still preliminary data because not everyone reports, including Tesla, on a monthly basis. We did see a modest uptick, so maybe kind of north of 8%, but not a massive uptick. August and September, I'm sure the industry will make a big push, so we should see maybe a more pre-buy, a pull forward. So maybe that number goes higher. In the fourth quarter, like for Tesla, we are assuming a decline in year-over-year U.S. volumes, I think 10 or 11% in Q4. But part of the question as to what happens to demand and ultimately sales will come down to whether automakers decide to just incentivize all or part of that credit that's going away. And so we'll have to kind of see as we get into the fourth quarter whether some say, hey, look, let's let the volume come down more naturally, or others decide to kind of maintain the volume via incentives.
I see. So before we talk about autonomous vehicles, let's just talk about the infrastructure situation. What is the charging situation like in the blue states versus the charging situation in the red states? Because that will determine to a significant degree whether somebody's going to buy one of these vehicles in a red state.
Yeah, it is more available where EVs tend to be more available, which is a bit of an issue when you think about chicken and egg and how do you drive adoption. But there are more investments, including Tesla Superchargers and other companies that are putting more chargers out there. One of the issues the last few years has been around the quality of some of the chargers. Like, can you have a good experience? And there's been a lot of improvement and efforts on the part of the industry to make that better. But
How long does it take now to charge a Tesla?
Depending where you start and where you go to, typically you want to go to 80% because then the charge speed dramatically slows. But you can get a very, very good healthy charge, 10, 15 minutes, 20 minutes. So
Really?
it's enough. Yeah, it's enough to, to go, grab. And typically the chargers are in locations near a supermarket or near a food store. You go in, you get something to eat, and then,
And then you
by
get
the
up
time
to
you come back-
80%.
Yeah, you can get up to 80%, relatively quickly. So, but here's why I think ultimately you can still potentially get pretty healthy long-term EV adoption even without solving every single pain point. And this is also why I think it's tough to be structurally bearish on EV adoption over the next 3, 4, 5 years. And it's a very, very simple reason. The US is incredibly unique because we have roughly 2 vehicles per household, the highest of any country in the world.
I got 3.
You got 3? Yeah, I got 2.
Actually, I have more than 3, but I don't want to brag. Or not brag, be embarrassed.
We'll call it 3 for now. So part of the case for adoption is just more households waking up and saying, you know what, EVs have a lot of great attributes, smoothness, brake regen, speed, of course, environmental, more interior space. Life is more interesting, more fun with one ICE or internal combustion engine vehicle and one EV. And if you kind of model what would happen if you were to see a quasi-rapid adoption of more households going from 2 ICE to 1 ICE, 1 EV, you could have a golden era of EV adoption. And arguably for the 5 or 6 times a year, long road trip in the winter where the EV has more pain points, that household can just take the ICE vehicle. And that's what makes, I think, a structural negative view on EV adoption difficult, and why I think you're still seeing some of the automakers continue to invest in EV because that is out there. And of course, we track it, as I mentioned, at TD Cowen on a county level basis. So every quarter we look to see signs. Think of a map and green dots lighting up of are we seeing signs in certain counties of more households maybe going to 1 ICE, 1 EV. And there are some, it's early days, of course. And the pushback typically is, well, are they all in California? And the answer is a lot of them are in California. But there are some others, including in New Jersey, where you're starting to see kind of rapid adoption kind of come out out of nowhere, but it starts to kind of happen kind of more naturally. And so if you were to see more product, affordability is key, and of course more medicine, to your point, on the pain points of charging and cost and all of the above, you could potentially see a catalyst towards driving that conversion to 1 ICE, 1 EV.
All right, so let's turn to autonomous vehicles. First question. I got a lot of questions about this. First question. Does autonomous vehicle technology work better in an electronic vehicle, or can it work equally as well in a combustion vehicle? That's the first question.
It can work in both, but experts will say it's easier to integrate into an EV platform. At the same time,
Because why?
Electrical architecture, power supplies, sensor integration. So it's what I've been told is it's just a little bit more painful to do it in a non-EV, but it's a lot kind of easier to do it into an EV. The other issue of why autonomous vehicles need to be kind of much more electrified, think about a Robotaxi or any vehicle that maybe you might own that is coming to pick you up today or going to do an errand for you, and it's driving miles without any human in the vehicle. So if you do get some increase in miles driven as a result of autonomy, I think a lot of different stakeholders would want those miles driven to be electric, to be zero emission. So there's a lot of different reasons why autonomy and EV kind of fit well together.
So before we get to who's good and who's bad in autonomous vehicles, there's a whole other conversation which we're going to do. You wrote a very interesting, one of the reports that you wrote kind of gave a list of all the things that could happen in a world of autonomous vehicles. So just walk me through the list. Robotaxis, but more than just robotaxis. What can happen in a world of autonomous vehicles?
Absolutely. Robotaxi gets 90% of the attention, but there's so much more that can happen in what we call a consumer AV. GM refers to it as a personal AV. So think about initial services in times a day that there's a lot less risk in operating an autonomous vehicle, but it could still be very value additive to your life. And so think of, let's say, the vehicle going to get service in the middle of the night. You go on your phone, I want a certain service, I want new tires, I want a car wash, and the vehicle wakes up 2 in the morning, goes and comes back with that service, or even 11 p.m. or 5 in the morning, because the safest autonomous vehicle arguably is a humanless vehicle operating in a relatively easy suburban road.
3 o'clock in the morning.
3 o'clock in the morning. And then from there, it could expand to you order delivery, from anywhere, and it goes to pick it up for you and comes back. It's your goods, whatever you order is in the trunk or the front trunk or the front.
So you're saying I could send my car to Walmart to pick up my groceries, and Walmart loads the car and it comes back and I never leave my home?
Absolutely. And eventually get your food for you and save on delivery fees. Drop you off at the bar, pick you up at the movie theater. If it's hard to park downtown, how about commuting? A lot of people will drive their cars and park at the train station, and then and sometimes they'll pay for that privilege, and then they'll commute. How about your car dropping you off near the train, near the bus, and then it goes home. And it goes home. To eventually, when you have scheduling conflicts in the family, the car can go pick somebody up, drop somebody off. And so there's so much about autonomy beyond just getting into a taxi. As large as a robo-taxi market we believe is and will be, the consumer portion is really interesting because it can certainly add a lot of value to now owning this vehicle. And it can be done, as we talked about, in domains that are relatively safer, but also are not mission critical. Meaning if there's a big storm or something else and the car can't go get the Walmart for you, you're not going to be as upset as if you're late to a flight or late to a meeting in a robo-taxi. So the services also are a little bit less risk for everybody and creates more flexibility.
Okay, so let's talk about Waymo versus Tesla, because you've written thousands of pages on this. So just talk to us first. How is Waymo's AV structured versus how Tesla's AV structured? Because from the tone of your report, you've expressed some skepticism that Tesla can be in a much more urbane setting versus Waymo. So let's kind of lay out that whole situation.
Absolutely. I think part of solving autonomy, to your point, Steve, is depends on what am I trying to solve? And if I'm trying to create a robo-taxi in Manhattan or San Francisco, that could be a very different development track, cost, sensors, as opposed to doing what we just talked about at 3 in the morning, which is maybe easier. And so I look at Waymo and Tesla as in some ways competing, of course. They already are in Austin.
Who makes Waymo's cars?
So they have suppliers, but they do a lot of the development in-house for the LiDAR, for example, and other sensors. They work with auto manufacturers for the vehicle itself. There's some tier ones who are involved too, but a lot of the effort is in-house. And they've done, obviously tremendous progress in the past year alone, right? For a while, people were kind of waiting and they were watching these Waymos in Phoenix, and suddenly there's been a lot of expansion and it's drawn a lot of attention, of course. So Waymo is certainly kind of going down the path to pursue more urban rideshare, right? The rideshare market in the U.S.
Where are they now in that? What cities are they in?
They're in several cities. They're in L.A. now. They've been actually saw one here in New York testing.
It's still testing.
It's still testing. But they're in L.A. They're of course the Phoenix area. They're doing really well in San Francisco.
When you say they're doing well, are they still testing in San Francisco? Or are they actually operating? They're operating.
Yeah.
So let me rephrase the question. In what cities is Waymo? And I could call up a robo-taxi and actually get it.
Yeah, San Francisco, the Phoenix area. They're in L.A., Austin, and then there's a number of other cities that they're expanding beyond that and doing testing. So typically, what they'll do is they'll test in a market and then they'll open up and kind of begin to scale. And so certainly today, Tesla is competing with Waymo in Austin for Robotaxi, and of course Tesla's pursuing Robotaxi as well. But ultimately, I think in the longer term, they have kind of different paths a little bit, right? Whereas if you create a vehicle like Waymo that has amazing technology, works really well, but needs more cost to support that technology, then the markets that make the most sense for you to launch are the dense urban cities where there's a lot of revenue.
And before we press that for a second, just explain what's in the Waymo car versus what's in the Tesla AV car that's different?
Yes, yeah, that's a good point. Yeah, it's a lot more sensors, and so
In the Waymo car.
in the Waymo. So Tesla's approach is a camera-only approach. There's about 8 or 9 cameras around the vehicle. You can kind of see them when you're walking around the vehicle. There's also one interior camera. And of course, a lot of compute, but that's effectively their sensor suite. Waymo has more of the traditional, and frankly, the much more popular approach, which is let's use multiple modalities, so camera, radar, and LiDAR. And the reason—
What's LiDAR?
Laser scanners.
Laser scanners.
And so when you think about like a radar, for example, can see through fog. It can see, right, like low light is not an issue. So at nighttime, it can sense well. The problem with radar is it's still pretty low resolution. LiDAR tends to have a really high resolution, but not quite like what the camera has. And it can have some occasional interference from light and other sources. So each sensor really has its pros and cons. And so the industry, and particularly those pursuing urban, complex, tough market robotaxi, let's do it in New York, let's do it in San Francisco, they, of course, want the best of everything and combining it. Now, a question we often get is, why not put like 1,000 sensors on the vehicle? And the answer is simple, because you're adding a lot more cost, of course, but you also create signal to noise, right? What happens when one sensor says stop and the other one says no, don't stop?
So what is Tesla? I'm sure Tesla's been pressed about this. When asked why you only use cameras, what's their response?
It is the richest sensor ultimately, and so and of course the resolution and the cameras do get better. So like when they updated Tesla updated their hardware to hardware 4 from hardware 3, those are better sensors, more field of view, and of course higher resolution. So the view is, look, the problem, what they'll say, is not that we need more hardware and sensors because of the issue of signal to noise and what's referred to in the industry as sensor fusion. What they'll say, it's a software problem, right? Just like you and I drive with our eyes. We can solve these issues with software, with AI. And look, at the end of the day, we have more cameras than what a human might, and there's some redundancy in the front with multiple cameras. And so when you think about the causes of unfortunate car crashes, whether it's fatigue or somebody driving drunk, right? The autonomous system can immediately not deal with those issues. And so with a camera-only system, there's an argument that over time with great software, you can get to a superhuman safety level alone.
But we're not there yet, in your view.
It depends on the domain. And so is there convincing evidence that we're there yet, like in a San Francisco or a very, very dense urban environment? You can argue there's not a lot of evidence of that yet, but in other areas,
not a lot of evidence of what?
Of being superhuman in like a very complex domain. Because a lot of it ultimately depends on where am I deploying? And so you can have a system potentially that is superhuman safe and very performant. Again, what we talked about before, like a suburban model, that may not be necessarily the best in an urban environment. And so I think we're seeing a lot of progress from Tesla and others, of course, Waymo and many other companies, just given the advancements in AI, compute, sensors, and there's a path to kind of getting there in easy domains. And I think we'll see how far Tesla can take it with their current sensor suite. But yeah, to your point, we are a bit more skeptical that Tesla has the right hardware to compete as well as others in the most dense urban environments. But I don't think that that's necessarily an issue, given that 80% of the U.S. population resides in the MSAs, or regions where we think the density of the population is sufficient potentially for Tesla to work really well. Only 20% is in the more dense areas that are still a TBD in terms of where they can get to.
How far away do you think Waymo is at this point from challenging Uber and Lyft for their basic business?
Sure. So our analyst who covers those companies would have a better view than me, but I think his view.
But he's not here, so we're just going to ask you.
I'll give a shout out. But I think that there's a case to be made in that industry of partnerships, right? I mean, it is not easy to operate a rideshare company, and there's a lot of ups and downs and peak demand and troughs. So I think that there's a view that in the rideshare industry today, which is about call it a $60 billion industry. Out of, by the way, a $1.5 trillion mobility market in the U.S., which we can come back to, but that partnerships are still really important between an autonomous player and a rideshare company. We don't think Tesla will necessarily pursue those, but the model we see them pursuing more attractively would be combined low-cost Robotaxi and the consumer AV model we talked about in more suburban areas, in the 80% regions of the population where we think there's a greater line of sight for that technology for Tesla to work best.
So let me express an opinion, okay? I don't own an EV. But if someone presented me with a fully functioning autonomous vehicle EV that could pick me up, take me to the train station, get my groceries, et cetera, that would be enticing to me to buy an EV as opposed to just another regular car. So how far time-wise do you think we are away from Steve Eisman saying, I'm going to buy an EV because this has so many more features than I could get with just buying a regular combustion engine car?
Sure. So Tesla is leading that effort right now in the industry, though to your point that there are other automakers. GM has talked a lot about personal AVs. They made a substantial hire not too long ago to pursue that. So it is being pursued by others, but Tesla seems to be in a multi-year lead. And so, they've talked about starting to do more of those types of FSD, as they call it, features.
What's FSD?
Full self-drive,
Right.
For consumers, maybe late this year into next year. So I would say if in the next 12 months, maybe 15 months, there's nothing on this front from Tesla, that would be disappointing to us and our thesis around what they can do. But the rest of the industry is probably still a few years away, but they're absolutely, from talking to a lot of them, are thinking along these lines. So maybe it's 3-4 years before this becomes a bit more of a reality more broadly.
But do you think Tesla could come out with something like this broad-based within a year? Next summer, let's say?
I mean, based on what they're projecting and saying, it seems like it. They ran a Model Y from the factory to a customer. It was about a 30-minute drive. I think this was back about a month or so ago, which frankly is the first such feature going live. A customer wants the vehicle, and the vehicle was delivered. It comes to their home, and so in some ways that they're starting to kind of get into this. They also had a post on X, again, also about a month ago, about hey, the car can get you your coffee on the way home from running an errand, and so they're already kind of talking more about it. I think the question for timing, of course, just continued iteration of the technology and improvement, but also how focused they are in the near term on the Austin Robotaxi and expanding that. So to me, it's a question both of technology and iteration, but also of just resources to when you begin to prioritize the consumer portion, relative to the Robotaxi.
So where is Chinese EV cars in the AV race?
So they've gone a lot of like not say all in, but they're certainly very aggressive in pursuing autonomy. You see a lot of LiDARs, sensors in the top of the vehicle, kind of the roof line. It's become actually pretty popular in China. A lot of those functionalities are still kind of eyes on but hands off. So what's known as like level 2+ in the industry. And there are a number of Robotaxi.
There's a driver in the seat, and the car is driven itself, but the driver can take control again.
Can take control. And there are certainly robotaxi companies in China operating and growing. It's hard to compare. I've not been there to test it out. I don't think there's a lot of people that I know, at least in the industry, who have been there and can really do a great comparison of like.
Well, what have you heard?
I've heard some of it is really impressive. I've heard mixed things from a few, but not enough to really be able to draw real conclusions. It also depends, if you were there 2 years ago, a lot has changed. So it's a great question because it's not a clear indicator of where it is exactly, but there's no question that there is a race. I mean, the Chinese, going back to earlier in the conversation of how they impressed on EV and technology, how did they kind of create their brands and achieve a lot of success? A lot of it was actually pivoting to the overall concept of a smart car, right? Great electronics, great features, big screen, software, and making a pretty big play on autonomy with a lot of compute and additional sensors, including LiDAR.
But there's no evidence that China, at least at this point, is ahead in AV. Is there, or is there not?
There are more companies in terms of pure like technology on an apples to apples basis. I can't say that there's clear evidence one way or another, but in terms of the amount of content or what like the push in the vehicles to have more of these features, they are ahead, right? I mean, today, a lot of their vehicles do launch with very advanced autonomy features. Again, maybe your eyes are on, your hands are off, you can take control. But in the U.S. and even Europe, those features, while they do exist, and there's some great systems even outside of Tesla, they're not that easy to find. You kind of have to go to find the right trim of the vehicle and get it. So
can you get that in a Tesla vehicle today?
Yeah, Tesla vehicle today, if you pay for FSD, you can get that.
But it's not standard.
Point to point. The hardware is, the software, the autopilot software is, so you will get some functionality. But if you want literally like the point to point, put it in your nav, go, and it's hands off, that is an extra subscription for what they do. So Tesla has the closest feature to that. And there's other suppliers who are launching these types of features with other automakers as well. But generally, the Chinese are kind of leading the way in terms of these particular feature sets.
So let's talk about something that makes people who own Tesla uncomfortable: valuation. I mean, the stock is selling at 80 times PE, something like that. So how do you think of valuation, if you think about it at all? And is basically, I mean, if you look at GM and the other car companies, they sell at single-digit PEs. Tesla's at 80. So what are people sort of counting on when they own a Tesla for them to say, I really got to own this stock because of what?
Yeah, absolutely. You're counting on autonomy, AI, robotics, but let's break that down a little bit more. What I do, particularly on the autonomous vehicle side, where we've done a lot of work, is sit back and say, are some of these business models that we're talking about, robotaxi, consumer AV, sufficient over time to justify the valuation and the upside? And I think they are. I mean, one way to think about it, as we mentioned a bit before, is there's a $1.5 trillion market. For a conventional automaker today, and I'll come back to the valuation in a moment, for a conventional automaker today, they're only realizing, by our estimates, about 40%, only 40% of the lifetime revenue that a vehicle generates, and a lot less so on a gross profit basis. In other words, the value chain today is a little bit messed up, right, in terms of like where the economics go. And so ultimately an EV, AV, all that we talked about has the potential to restack that within this $1.5 trillion U.S. market. So we do believe that when you run the numbers, again, a lot of assumptions, a lot of risk in those assumptions, but ultimately the path is there. We're getting closer to that path. You can justify it. And then I sit back and say, okay, now let me look at two things for the stock itself. One is sentiment, and the other is catalysts. Because ultimately, I think that's what will drive the stock once you gain comfortable fundamentally about the opportunities that you believe in. And years ago, when they were doing a 25% gross margin, and their cost of goods sold per unit was pretty low, there was this view that they'll be able to ramp to 20 million units. You probably remember this years ago, by 2030, 20 million units. And
Now they're at 1.5.
1.5. And it was, because there's always, when it comes to sentiment and catalysts in the auto world, I'm sure in other sectors, a lot of over extrapolation, right? Go back to '09 with dozens of examples, pickup trucks, auto sales. And so people were over extrapolating this many years ago. And it was a pretty flawed case at the time because it was clear there was tight supply demand. We talked about product refresh and all the things that eventually brought earnings down 50%.
Where are the margins now?
Now in the mid-single digits, about
So
5%.
they were in the 20s and now in the mid-single digits.
That's EBIT. On a gross, it's in the teens, like mid-teens or so.
So when you were saying it was in the 20s, now it's about 15.
Yeah, about 15, 17%. Okay. Yeah, for the gross. Yeah, for EBIT, we're now at about 5% on a GAAP basis, give or take. So back then there was over extrapolation. Sentiment was really robust, and at the time it failed to appreciate that a vehicle is an emotional purchase. In other words, you could have a cheaper vehicle, you could have a great vehicle with great software, but if you don't touch that emotion of the consumer, you're not going to sell. Today, it's the complete opposite, right? What's the view? The EV market's dead. It's going to go down. We talked before about why it's tough to be structurally bearish for 2 or 3 or 4 years because of the one ICE, one EV household potential. Tesla's product lineup, while it is being refreshed and there's a lot to come, it's still losing share. There is competition. So today the sentiment around the EV business is low. And on the AV side, while there's definitely more excitement after Austin, the stocks performed pretty well because of that. There's definitely still, I think, a lack of appreciation to what we talked about on the consumer AV side, where 90% of the conversations are on Robotaxi, again, a large market that we're bullish on, but there's a lot more in that $1.5 trillion U.S. mobility market against a $60 billion rideshare market, meaning that there's much more to go. So we like the stock typically when we think sentiment is low. It is on EV, it seems like, even on the AV side, and where there's potential catalysts that could be monumental. So if they do start to launch these features, expanding Austin.
So when was the Austin event and what happened at the Austin event?
So Austin, they launched their Robotaxi. It was in mid-June.
Okay.
They launched their Robotaxi rideshare service. They're still running it. I've not yet been down there myself, but there's a lot of videos, a lot of feedback from that.
And what are you hearing?
So far, it seems to be going fairly well. There is a person in the passenger seat, so it's driverless, but not humanless in terms of somebody being there. But it seems to be.
So it's still in the experiment stage.
No, it's running. I mean, it's not open yet to the public.
But there's no driver.
No driver.
So you get in the car. I'm the passenger. I get in the back seat, and there's a computer driving the car.
Yes. To be fair, there is a person from Tesla in the passenger seat, so not driving, but in the passenger seat.
The front passenger
seat.
And
so
what does that person do?
I think they're to monitor. Maybe it is possible they have, and again, I haven't experienced it yet. We just from what I've seen and heard and talked to people, they do have the ability to hit a button, perhaps to stop the vehicle. But so it's an extra safety layer that I think the company will, of course, at some point remove because you want to be careful, right? We've seen what happens if you go back to the terrible Cruise incident years ago. Like if something goes wrong with an autonomous vehical company,
bad publicity,
a lot of bad things, and so I think it is. We agree with Tesla wholeheartedly that you want to do a walk before you run approach. So it is driverless, but there is a person there in the front passenger seat, and the zone in which they're operating, what's called the operational design domain, or ODD, which just refers to which roads are you approved, not by regulators, but approved by the company, by Tesla, to operate. That has expanded already from the initial zone. So it's actually been, I think thus far from what we can tell, pretty successful.
Let's switch gears for a little bit. Talk about some other car companies. Let's talk about first the other EV companies. Are there any EV companies in existence in the U.S. now that you think challenge Tesla really in any serious way? Or are they just sideshows, like a Rivian, et cetera?
They're certainly challenging in the sense that Lucid has great technology. Rivian has great product and great technology as well, and has seen more commercial success thus far than Lucid. So you have seen companies that have come out with compelling product, but you can almost think about them as you know how like Tesla went through like its production hell period and it was rough and eventually they got out of it. These companies are still sort of going through those iterations where the first generation product, even though, you know, like in Rivian's case, it was successful and, you know, Rivian actually has a very large share of the like luxury SUV market at its price point, they're now going through their next generation of let's get the more affordable vehicle out there. And so in the meantime, they're losing money, there's burning cash. And so from that perspective, they're not a threat, but they are coming out with the next generation. And the one thing with EVs that's important to keep in mind is the rate of, like we saw with China too, the rate of improvement in cost and capability from one generation to the next is pretty impressive. I mean, Ford just earlier this week announced a $30,000 electric midsize pickup truck that $30,000 starting price. $30,000, wow. Yeah, coming out in 2027. So these companies are in you know, getting ready for the next generation product, and so next year is going to be key for both.
So let's talk quickly, anything interesting going on in GM, Ford? Like, do you like any of these companies at this point? Like, talk to me about the rest of the auto sector that you cover.
Yeah, we've been more bullish on the sector. GM's been our top pick for a number of reasons. If you think about the last few months in the auto sector, when tariffs hit, a lot of people, forecasters, analysts, rapidly cut their numbers, production, demand, on the view that auto prices will go up by 10 or so %. It was a flawed view. We actually ran our own analysis that argued kind of the opposite, that you wouldn't see pricing go up by more than 1.5%, and that's so far played out. And so you've seen upward revisions of people's expectations for auto sales and production. Interesting, that's helped stock prices. But the more interesting aspect is I believe that there is fundamentally stronger auto demand in the U.S. than commonly believed, which is also why the new vehicle sales have kind of beaten expectations throughout the year. At TD Cowen, we do a survey, a proprietary survey called a density survey, and it forecasts where vehicle per household will go. And I won't bore you with all the details, but effectively, we think that one of the tailwinds in the U.S. auto market is coming from deurbanization. It actually began deurbanization. Yeah, it began really during COVID, and it seems to be sustaining. So we think there's upward pressure on that ratio of cars per household, which is driving upside to new vehicle sales. It's good for GM and Ford, and of course others as well. So we've been pretty upbeat on that too. More recently, some of the changes in emissions regulations, we talked about some of that from an EV perspective, can also be beneficial for the kind of traditional automakers as well. So that's like a third incremental tailwind.
Those emissions have been reduced. Weakened.
Yeah, they're not final yet. We're still waiting for clarity from the EPA, but directionally things are going in that direction, and that opens up opportunities to sell a richer mix of more profitable vehicles. Think more pickup trucks, more large SUVs. So that could be a tailwind for them as well. So you have a situation where just 3-4 months ago, people were very bearish on tariffs and what volume would do. They were just overly and still pretty bearish on auto demand. Those two have gone in a much, much better direction than consensus believes. Just in the last few weeks since Q2 reporting season, this theme of like easing emissions regulations and how big that could potentially be is gaining momentum, and that's all accruing pretty well to the industry. So we've argued that there are better prospects for sentiment to really turn positively on these names over the next 6 months as some of this plays out.
Let me finish up with what we'll come back to summarize, but I just want to talk about Aptiv for a second. I was looking at the stock. First of all, tell us what Aptiv does, and I'll get you my question.
Sure. Aptiv is an auto supplier. They're called a Tier 1 auto supplier that they sell directly to the automakers. And they have various businesses, mostly kind of tied within car electronics and software. So think about the wire harnesses in the vehicles, compute, active safety systems like radars and cameras that go into it.
So here's my question. So if I look at Aptiv, it's a $14.5 billion market cap. It's up a little bit this year. It's got a PE of 9 times. But when I look at the earnings, they've only gone straight up. But back to when the stock was at its peak, it sold at like 50, 60, 70, 80 times earnings. The earnings have never gone down. They've only gone up, but the multiple has been obliterated from, call it 60, 70 times to current 9. I know nothing. What the hell happened?
It's a great observation. So one of the metrics that can drive multiples for auto suppliers is, and it's very, very simple, it's your revenue growth relative to auto production. So if you grew revenue by 5% and auto production grew by 2%, you have 300 basis points of growth over market.
Got it.
And prior to COVID, we were in this kind of golden era for auto suppliers where that growth over market metric was very, very strong. Aptiv at some point thought it can grow 8 to 10 points above market. And I think looking back, there were a lot of reasons why that metric was strong. There was richer mix of vehicles being produced. There were richer
electronic mix.
It was both electronic, but also just more trucks, more SUVs, where a supplier like Aptiv has more revenue, more content, as well as trim mix. So if you sell like a high country Chevy as opposed to the LT version of the same vehicle, the suppliers on that vehicle will have more revenue on the high country trim. So we had this golden era where all these things are going really well and driving up this growth over market metric. The only problem is that a lot of people at the time interpreted that metric as purely a function of secular growth, EV, safety, right, software-defined vehicles, when in reality it was part of the driver, but not the entirety. But investors were almost conditioned to some degree to look at that metric, a simple metric, flawed in many ways, but a simple metric as purely a function of secular growth. Fast forward in the last couple of years, a perfect storm hit that brought that ratio down to like nothing. Some of it was the delay in EVs we talked a little bit about. Some of it was just circumstantial changes in some of the customer success. Some of it was the rise of the Chinese automakers, which took share from many of the global or the multinational automakers, which Aptiv and other auto suppliers were very exposed to. So that ratio shrank, and that's what really hurt the multiple.
But the earnings are up 30% per year regardless.
Yeah.
How did they do that?
Yeah. So still able to, and even this year, to really run the business efficiently and expand margins. There are also a lot of disruptions where they're able to kind of pass the cost along and therefore be able to grow earnings. Of course, auto production has been recovering to some degree, and they've been buying back a lot of stock as well. But the one thing the last few years that didn't go wrong, and one of the best metrics that often gets a little bit of pushback because it is a little bit of a subjective metric, because it involves a lot of assumptions, is bookings and backlog. And when you look at Aptiv historically, when they report annual bookings, it does tend to lead future revenue by several years. You win a business, you launch it in 2 years, and you ramp it with your customer. And Aptiv's bookings the last few years have been in the north of $30 billion against a $20 billion revenue base today. And so if you kind of run the math and say, if revenue will get to $30 billion in 6, 7, 8 years, you do get back to a healthy mid-single digit revenue growth. And to your point, Steve, if the margins have been strong.
Where's revenue growth now?
In the last few years, it's been kind of nothing, and now it's
so
back
it's
to
all
like
margin.
A lot of it's been margin.
Okay.
The outgrowth has been lower. Now we're kind of back to more like low single digit organic. In the second half of the year, they should see some uptick in kind of that organic revenue growth. But there's been so much even noise in the revenue growth from FX, from commercial recoveries, that it's just been again a perfect storm of everything kind of going wrong in what was thought to be a pretty simple, straightforward algorithm.
I see.
And now I think we're kind of reverting back to sort of a truth is in the middle kind of outcome, where I don't think we go back to 8 to 10% type of revenue outgrowth, but the backlog and our estimates support kind of mid-single digit, which is better than they've done the last couple of years. And so with the margins also being strong in the tough times, we think that there is a path for mid-single digit revenue growth and therefore kind of low double-digit EPS growth. And so we like the stock.
I think it's astonishing that a company, forget about the revenues, that has literally grown EPS 30% per year during this entire period, has seen its multiple cut by 9/10. I mean, it's unbelievable.
Yeah,
they must be in shock.
Yeah, that's something they've done a lot of buybacks, and it goes back in auto of a lot of like over extrapolating trends, right? Back in 2009, we were told the pickup truck market, which is the biggest profit pool in North America for the automakers, was in a permanent decline. When the data and the evidence ultimately proved, and it wasn't like 10 years later it proved, you could have seen this coming many, many years before. The pickup truck demand was actually rising. We were told that new vehicle sales after 2009 would never go back to 17 million units per year, and they did. And so a lot of it comes down to this over-extrapolation. We talked about it before with Tesla as well. And for a name like Aptiv, this perfect storm, which a lot of it, was surprising. What happened in China, the rise of the Chinese automaker surprised us too. But ultimately, the bookings is where you find the best clues for where this business is ultimately going. Are you winning business with the local Chinese companies, which Aptiv has been? So ultimately, it's sort of a reversion to the mean a little bit. And we think the stock is undervalued.
So let's rank, the stocks that you're recommending. What are your top three in order right now in your head?
Yeah, GM's our top overall pick. Aptiv has been our top supplier pick. Invisteon, ticker VC, has been our top SMID idea.
And where's Tesla rank in your pantheon?
Yeah, away from those like designations, we don't have a complete, because Tesla is such a different animal to some degree. Like it's less about SAR and production in the near term and more just about autonomy. We like Tesla. When we initiated coverage back in March, I just felt that sentiment was low, catalyst paths were there, and that's still a view that we hold.
So just to sum it up, would you agree with the statement that the future of Tesla and whether sales are really going to come back after the credits are gone really rests on how quickly they can ramp up AV?
I would agree, and also just add that new product, the more affordable products, are also going to be important. Eventually, even a wider array of products. So it still comes down to product as well as autonomy. When Tesla launched the Model S and then the X, they generate demand on their own, right? They kind of like created this sort of category and an excitement on their own, and were able to kind of chart the course of the market. And so I think, irrespective of what happens with credits and all the noise, at the end of the day, if you put out great product and a compelling offering, you will be successful. AV is certainly a big part of it, given where they're at and just the amount that you can unlock.
Because that's the only thing that's going to get me to buy a Tesla is the AV. So I'll let you know.
Yeah.
If the AV really ramps up, then we'll know it's a success because I have bought one.
Absolutely. That'd be a great barometer.
Itay, thank you so much for your time.
Thank you for having me, Steve. It was great. Really enjoyed it. Thank you.
This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.